Welcome, everyone. I'm Mike, and joining me today is Susan, the expert who helps us connect all the crucial data points in the rapidly evolving world of enterprise technology.
It's great to be here. We are looking at one of the most compelling conflicts in tech right now.
We really are.
A company that is delivering flawlessly, just executing perfectly, yet it's being punished relentlessly by the market.
The company we're focusing on is ServiceNow, ticker NLW. They are, the undisputed leader in digital workflow automation. But first, a quick but important message for our listeners. Welcome, everyone, to vpod.ai. You can sponsor this podcast for just $25. Your message will be featured across major platforms like Apple Podcasts, Amazon Music, Spotify, and more. If you're interested, contact info at vpod.ai to get started today.
So our mission here is to analyze the stack of information we have, reports on stellar financial results, overwhelming analyst optimism, but also major valuation risks and these intense competitive threats.
Right. We want to give you a fully realized picture of why this stock is so turbulent right now. It's a textbook case of perfect execution meeting market skepticism.
And that tension is absolutely key. Our goal is to synthesize the competing views. The bull case, which is all about strong growth and incredible retention, versus the bear case, which focuses on that high valuation and, frankly, what looks like an existential threat from AI competition.
So you can walk away with a really nuanced understanding of where the company stands.
Exactly.
Okay, before we jump into the numbers, let's just quickly set the stage. ServiceNow specializes in enterprise digital workflow automation through its Now platform.
Right. Think of it as the operating system for making a large company run efficiently.
Yeah, across IT, HR, customer service, security operations, all of it. They integrate AI, analytics, low-code tools. It's a crucial piece of infrastructure.
And a big one. Its market cap is sitting somewhere between, $164 billion and $179 billion. It's a giant.
Okay, let's unpack this financial contradiction. Despite being a major enterprise cloud platform, the stock, it's been lagging. Hard.
It really has.
We look at the performance over the past 52 weeks and year to date in 2025, and ServiceNow has declined significantly, down nearly 19% and 20% respectively. I mean, that is dramatic underperformance.
It is, especially when you compare it to the overall market. The S&P 500 index, for instance, it gained over 12% in that same 52-week period.
And it wasn't just the broad market, right? It lagged its own sector.
Yeah, its own peers in the software sector, too. The iShares Expanded Tech Software Sector ETF, that's IGV, was actually up 2.3%. So ServiceNow is really trailing here.
And the core paradox is that this stock dip happened despite ServiceNow delivering just phenomenal operational performance.
Absolutely. They are executing flawlessly, and yet the stock is struggling.
So let's focus on those Q3 2025 results.
The results were exceptional. They came out on October 29th, and, they initially caused the shares to bump up about 2.5%, which just proves that fundamental strength.
And the key metric, subscription revenue.
It climbed 21.5% year over year to hit $3.3 billion. Total revenue advanced 22% to $3.4 billion. And critically, this beat allowed the company to raise its full-year outlook.
And that was driven by AI adoption, right?
Specifically by strong early AI adoption and, sustained enterprise spending. Customers are still writing big checks.
And their backlog numbers,
yeah,
they look like a fortress.
They absolutely do. Their current remaining performance obligation, or CRPO, which is the key indicator for near-term contracted revenue, that was $11.35 billion.
Up 21% year over year.
Exactly. And the total RPO, the full lifetime contract value, hit $24.3 billion. That's up 24%. It just gives them tremendous visibility for years to come.
So here's where the narrative gets, really twisted. Wall Street's official consensus. If the market is punishing the stock, you'd expect analysts to be divided. But they are so unified in their optimism.
It's kind of shocking, actually.
Analysts expect solid growth for fiscal year 2025 earnings per share. They're forecasting a huge 35.8% year-over-year growth.
And the consensus rating among the 41 analysts covering the company is an undeniable strong buy. We're talking 33 strong buys versus only one strong sell.
Just one.
Just one. And the price targets are astronomical. The consensus target is $11,159.94. That's a 36.5% premium over current levels, with the street high target hitting $3,332.
So wait, if 40 out of 41 analysts are screaming buy and the stock is still down 20% year to date, doesn't that suggest the analysts are maybe missing something? What is the market actually seeing that makes it so cautious?
It's the valuation. Pure and simple. It's a wall of skepticism.
Okay, so that brings us right to it, the valuation wall. This is the core of the bear case.
It is. ServiceNow's financial metrics, they just scream premium, and investors are asking if that premium is really justified, especially in this changing competitive environment.
Let's put that premium into context. What do the price multiples actually look like?
They are very high. We are looking at a trailing price to earnings, or PE, ratio of 95.73.
95.
Yeah. And even the forward PE, which is based on those bullish future earnings estimates, is still 45.25. Now, a high PE is often justified for a hyper-growth company. Sure, investors will pay for future earnings.
But you have to compare it to the competition.
Exactly. You contrast that PE of 95 sharply with its larger established rivals, and the market concern just crystallizes. Microsoft is sitting around 33, and Salesforce is all the way down around 18.87.
That's a huge gap.
Yeah.
It means the market believes ServiceNow's massive growth rate has to continue perfectly without any interruption for years just to justify that price.
Precisely. Any slowdown, any major competitive threat, and that PE just collapses. It is richly valued compared to rivals who often have higher net profit margins and, a broader market reach.
But to be fair, it isn't just hype. The fundamentals underpinning this high price tag are genuinely robust.
Oh, absolutely. The recurring revenue model is incredibly strong. They've maintained robust revenue growth, averaging 22% over the last 3 years.
And the gross margin?
Exceptional, 78.05%. That's really best in class for the software industry. But the metric that truly demands a premium is that customer retention.
The 98% number.
Yes. A 98% customer renewal rate across their 8,400 enterprise customers. That level of stickiness means their platform is it's mission critical.
98%. I mean, that is staggering.
Yeah.
It just shows how difficult it is for a large company to rip out the ServiceNow platform once it's in there.
It's a phenomenal moat, but there is a critical financial red flag that feeds into this whole caution narrative.
Okay, what's that?
The company's return on invested capital, or ROIC, is 7.48%, and that figure is currently below its weighted average cost of capital, or WACC.
Okay, now, for those of us who aren't corporate finance experts, can you break down why that ROIC versus WACC comparison is so critical?
Yeah, let's simplify it. Think of ROIC as the return you get from an investment. WACC is the actual cost of the money you had to borrow or raise from investors to make that investment. So when your ROIC is lower than your WACC, which is the case here, it signals that for every dollar the company invests, it's generating less return than the actual cost of raising that capital.
So long term, that suggests some kind of inefficiency.
Exactly. Inefficiencies in how capital is being deployed despite the massive growth. It makes the stock look vulnerable.
And adding to that internal caution, we have noted some insider selling activity from senior executives recently.
Which always acts as a caution sign for investors on near-term sentiment,
Right.
And that valuation tension, it only really matters if a competitor can successfully disrupt them. And this leads us directly to the real threat to that premium valuation, the AI agent battleground.
Let's unpack this competition risk, because it's not just about better software anymore. It's about shifting the core engine of the enterprise. And ServiceNow is facing off against Microsoft and Salesforce.
Two of the largest tech companies on the planet. This battle for AI orchestration is the central driver of the stock's recent volatility. KeyBank, when they downgraded N now W, explicitly cited competition from Microsoft in this exact area.
And they put a timeline on it, didn't they?
They did. They predicted the ramp-up will be severe by 2026. And what's crucial to understand is what an AI agent even means here. This goes far beyond a traditional chatbot that just answers questions.
So how is an agent different from a sophisticated chatbot?
An agent uses large language models and generative AI for a bespoke humanistic service. It leverages vast amounts of organizational data to proactively initiate and complete entire workflows based on complex reasoning.
So it doesn't wait for a prompt.
Exactly. It anticipates a need. It manages concurrent tasks to solve a problem like, say, automatically updating the security patch, notifying all the affected users, and generating the compliance report, all without any human intervention. That is an existential threat to traditional workflow tools.
Let's compare the three key platforms fighting for this space, because they each have a slightly different strategy.
Okay, starting with ServiceNow agents. They're built directly on the Now platform, using advanced reasoning and unified data to reinvent workflows. Their vision is really compelling. People will become administrators of an entire team of AI agents.
And they have tools for that.
Right. The Now Assist Skills Kit, which lets customers build, test, and deploy their own custom Gen AI skills specific to their business.
And then there's Microsoft, who has the entire enterprise stack already installed pretty much everywhere.
That's their huge advantage. Microsoft Copilot agents have been available since November 2023. Their advantage is ubiquitous integration. Users can create and publish these agents within Microsoft 365 Copilot, so they show up right inside Teams and SharePoint.
And their angle is security.
They're really emphasizing security, keeping data within the Microsoft 365 or Azure trust boundaries, leveraging their enormous existing footprint.
And finally, Salesforce, focusing on the customer front end.
That's right. Salesforce announced Agentforce. They're stressing this Agentforce in every app approach. So you have specialized service agents, sales agents, marketing agents.
All powered by their own
Or
engine.
powered by their custom Atlas reasoning engine. And their early success rates are impressive. They're stating some pilots are hitting 90% case resolution.
So ServiceNow is fighting these two massive companies coming at them from different angles. Microsoft from the productivity layer, Salesforce from the customer relationship layer.
It's a pincer movement, and what's sobering, despite all the advanced security being built into these new AI systems, is the risk side of this, trust and safety.
Yeah.
If these agents are handling mission-critical data, the recent history of data leaks at both Microsoft and ServiceNow, it really complicates their pitch.
It absolutely does.
Yeah.
This reminds us that no amount of code sophistication can fix human error. Look at Microsoft. In 2023, an AI research team inadvertently exposed 38 terabytes of internal data.
Including passwords and, what was it, 30,000 internal Teams messages?
All from just uploading training data to GitHub. A simple mistake with huge consequences.
And ServiceNow had its own issues recently, too.
That's right.
Yeah, thousands of companies were revealed to be potentially leaking internal secrets from their own knowledge base articles, all due to misconfigurations in the ServiceNow platform itself. This is a crucial point for investors. The whole AI agent future relies on absolute trust in data security, and both key players have recent high-profile lapses.
So we have this world-class execution, a huge valuation premium, and the looming threat of tech titans in the AI space. What does all this mean for the stock price today? Because the stock dropped over 10% recently, and the immediate catalyst wasn't even earnings.
The immediate weakness came from two specific events. First, that KeyBank downgrade to underweight with a $775 price target. That added significant bearish pressure.
And they cited the AI risks.
They did, specifically the AI risks, but also concerning trends they saw in IT back-office employment data, which suggests a potential slowdown in enterprise spending on these specific services.
But the primary driver of that immediate drop was the news of a big acquisition.
Correct. The primary fear came from an unconfirmed report that ServiceNow is in advanced talks to acquire the cybersecurity firm Armis for up to $7 billion.
This raises an important question then. Why would news of a strategic acquisition cause such a sharp drop? You'd think that would be good for a growth-focused company.
Well, investors are weighing the strategic upside, which is bolstering cybersecurity and IoT capabilities, against the massive execution risk. A $7 billion deal is huge for ServiceNow.
And integrations are hard.
Integrations are incredibly hard, and this deal could be dilutive or, even worse, distract management from that core AI agent battle against Microsoft and Salesforce. When you're trading at a PE of 95, the market demands relentless focus, not large, potentially distracting acquisitions.
And that insider selling activity we mentioned earlier, that also plays into this immediate sentiment, right?
Yeah, it does. The consistent insider selling from senior executives in recent months is seen by investors as another caution sign. It signals a lack of near-term conviction from those closest to the business, right before they announce a major risky capital deployment.
But despite all the negativity, the bullish conviction hasn't completely vanished from Wall Street.
Absolutely not. As a powerful counterpoint, William Blair recently reiterated a buy rating on the stock, so there's still confidence on the street in the company's longer-term strategic direction.
So some analysts believe the benefits of adding Armis and dominating their niche will outweigh the short-term pain.
That's the bull case. They think the company can walk and chew gum at the same time.
That is a perfect encapsulation of the risk and reward here. To summarize the key tension for you, ServiceNow has top-tier financial momentum. We're talking over 20% revenue growth, 98% retention, high gross margins. But it trades at an eye-watering premium.
And that premium is now under this existential threat from tech titans using their scale to compete directly in the essential forward-looking AI agent space.
If we connect this to the bigger picture, the market seems to be saying that while ServiceNow is executing perfectly on its current business, its high valuation means it has zero margin for error.
Zero. Any misstep, whether it's the high integration risk from a massive $7 billion acquisition or a failure to dominate the next wave of AI, it's being punished immediately. The stock's high volatility, its beta of 1.2, that reflects that constant internal pressure.
Which brings us to our final provocative thought for you to mull over. Given that the stock is highly volatile, focused on a massive, potentially risky acquisition, and facing unprecedented competition, should the strong consensus, strong buy rating outweigh the fundamental caution sign that the company's return on invested capital is still below its actual cost of capital?
That conflict is worth deeply considering as you track ServiceNow's next move.
Thank you for joining us for this analysis of the ServiceNow paradox. We hope this exploration provided you with the full, complicated picture of this crucial tech leader today.